All right, well, let's get going in the interest of time and information. I'm sure we'll have others join us. I got a couple of comments, and then we'll open it up to the panelists. First, we want to thank everyone for attending the virtual event. My name is Doug Greenberg, and I'll be today's moderator as well as one of the panelists. This event, just a bit of history, this event is a continuation of a regular series that we used to have every few months over lunch at Jake's Grill. We would facilitate a free-flowing discussion based on the attendees' questions or concerns about the various steps or processes of selling their business. We're pushing towards that free-flowing discussion. It worked well in person, and we hope that we can accomplish that in the virtual meeting. So we wanted to give it a try. We would like the attendees to participate by asking questions and sharing about their own experiences where appropriate. A few Zoom housekeeping comments. Right now, the participants are on mute. So if you'd like to ask a question or make a comment, please unmute your microphone, which is in the lower left-hand side of the Zoom bar on the bottom of the window. Ask your question and then remute. If you don't want to ask a question verbally, by all means, you can ask a question through a text. And that's the chat button is in the middle of the Zoom bar on the bottom of the window. If neither of those work, just wave your hands and we'll unmute you. And please keep in mind the event is being recorded. The topics discussed are for informational purposes only, and you should speak with a legal, tax, or a financial advisor before taking any action on anything discussed. Our today's format, each of the experts will give a brief introduction, and then we'll begin the discussion. So if you have any questions, now's a good time to think of them. Lee, I'll turn it over to you for an introduction.
Great, thanks, Doug. I appreciate you inviting me to participate in this panel discussion. Unfortunately, I wasn't able to participate in the lunchtime discussions, and hopefully at some point in the future, we'll be able to get back to being able to have a lunchtime discussion in a little bit more informal environment, as I find that tends to work good for kind of open type discussions such as this. But my name is Lee Foster. I run a company called BV Advisors. It's a business valuation litigation support services firm. It was a company that I founded in 2002. I started my career, though, back in 1990 doing traditional accounting work as a CPA. I did that for about the first 5 years of my career in Southern California as well as in Oregon. Moved to Oregon in 93 after the several earthquakes in Southern California and the riots in South Central Los Angeles, of which I actually did some audits immediately after the riots in South Central. And my wife said, I'm going to Oregon to be home, closer to home. You're welcome to join me if you like. And here we are, some almost 30 years later. So started my career first 5 years doing traditional accounting work, audits, reviews, compilations, tax returns. And I've done write-up work from bookkeeping, property tax, payroll tax, income tax, corporate tax, et cetera, as well as the financial statement preparation. Got into valuation services in the mid-90s with a guy from Ernst & Young. Then I ended up at Arthur Andersen for 4 years, heading up the Portland practice, working with partners out of Seattle and San Francisco. So I went from working on kind of smaller middle market companies to working on very large middle market to very large publicly traded companies, including, I think the largest deal that I worked on was a $50 billion transaction that Deutsche Telekom bought VoiceStream, which is known today as T-Mobile. Left Andersen when that ship went down in 2002 and started BV Advisors in 2002. All our firm does exclusively is valuations and litigation work. 4 primary areas that we focus on: taxation, financial reporting, M&A, and litigation. On the tax side of things, we focus on gift and estate tax valuation work for compliance purposes, share-based compensation under 409A. We also do some transfer pricing work for international-based companies. On the financial reporting side, most of our work is intangible asset valuation for financial reporting purposes. as well as some under ASC 805, the accounting standards codification, and then also some work under ASC 718, which is the financial statement version of 409A. It's share-based compensation. On the M&A side, on the transactional side, our role is primarily an advisory role. We don't broker businesses. We're not a business brokerage firm, but we can help buyers and sellers understand the value of their business from an independent perspective. And that's what we do very frequently. We've done a lot of that work in the last several years, especially. On the litigation side, we get involved in pretty much any type of litigation that involves valuation or economic damages, lost profits, shareholder disputes, marital disputes, personal injury, wrongful death, wrongful termination, that kind of stuff. So that's a brief introduction. So I'll turn it over to Bob.
Okay, thank you. My name is Bob Kabacy, and I'm one of the partners at Kell, Alterman, Runstein. I've been doing state tax transition planning for the last 27, 28 years. A couple of years before that, we did litigation, and learned that I just didn't want to do litigation as a career, but I understand how litigation works. And so that's helped me quite a bit in planning for estates, as well as valuation, which is the topic today. Our firm's been around since 1929. We do mergers, acquisitions. I primarily focus on estate work, corporate asset protection, and tax strategies, as well as transition strategies, both wealth with families and business transition strategies. Our firm is full service. We do just about everything except for, I don't think we do workers' comp right now, and we also don't do bankruptcies right now. Other than that, I thought what I would do is kind of kick us off. I talked with Doug yesterday just briefly, and I thought I would kick us off with valuation and give us some background on the topical matter for today, and then we can launch into the discussion. So Doug, with your permission, I'll talk about some of the things that we discussed yesterday and go through that list.
Fire away.
Okay, so I was driving in this morning and I thought, what is valuation? What does valuation mean? And I think, and Lee probably would agree with me, valuation is really a result driven by an analytical process. The ultimate result of the valuation is a number that you're seeking. That's different than an evaluation. A valuation is something that's a formal report given by an expert with supporting documentation. An evaluation is an informal ad hoc sort of determining what the worth is. So there is a difference. My clients use evaluation and valuation interchangeably, and I never correct them because I kind of know what they're getting at. Valuation, to draw an analogy, is a little bit like washing dishes. Valuation is a result, remember, and when you're washing dishes, you want clean dishes at the end. The way you get there, though, can be quite a bit different. You can hand wash dishes, you can use a dishwasher, or you could even leave the dishes out in the rain and hopefully they get clean that way. And then each one has sub-methods. So, hand washing, you can wash with the water running, you can wash with a pool of water. Dishwasher, you can load the dishwasher from the front, you can load the dishwasher from the back. By the way, that is an issue in my household. Or you can also, forget your dishes outside on a summer night and hope that the rain cleans them. And it could be a downpour, it could be a drizzle. But there, valuation is similar in that there's many different ways to get there, and it's a little bit subjective in that there are ranges, but the ultimate result, like having clean dishes, is to have a good valuation. And like dishes, sometimes they don't get all the way clean, and with valuation, sometimes you don't get all the way to the exact answer. But as Lee alluded to, valuations are used when you're looking to determine worth of something before a transition, for gift tax purposes, death tax purposes, to determine cost basis, and also for interfacing with regulatory authorities. I think one of the things we have to keep in mind when thinking about valuations is the audience that you're playing to. different valuations can serve different purposes. If you're dealing with regulatory authorities, we may want a more formal valuation. If you're looking just for curiosity, we may have a less formal valuation. But the audience will have a factor in how the valuation is done, and that could be a family, partners, prospective purchasers, divorcing spouses, courts, regulatory authorities. So different audiences could produce different valuations. We'll get into some of the tools later on of what valuations are used for, like gifting, sales, death, and stuff. And we'll also probably talk about where discounts fit into valuations and how sometimes valuations can be challenged. And then Doug, just as a placeholder toward the end, if we can spare just a couple of minutes, I'll go through 6 mistakes that I've identified that people make when doing valuations and what the fixes for those mistakes are. So
Great.
I think with that could kick us off on this valuation topical matter today.
Lee, do you want to step in to the next slot there?
Sure. Yeah. No, I agree with a lot of what Bob said. I mean, in the valuation community, we don't really refer to an evaluation particularly. And the reason we don't is because our standards dictate that we refer to things very specifically. And so like in accounting, where you have an audit, a review, and a compilation, that's 3 different levels of analysis and reporting, et cetera. In valuation, we have that same thing that Bob referred to. We have an appraisal or a valuation engagement, depending on whether you're talking about the American Society of Appraiser Standards or the AICPA, American Institute of Certified Public Accountant Standards, on kind of the full detailed analysis, reporting, et cetera. And on the other end of the spectrum, you have a calculation engagement, which both sets of standards refer to as a calculation engagement or a calculation of value. There are some substantial differences between those 2 scopes of analyses. The appraisal is going to be a very detailed analysis. It's very in-depth. It's going to be all of the appraiser's judgment. The appraiser is going to select all of the methodologies, the approaches that they're going to use to determine the value of a business interest or intangible asset. They're going to be very rigorous about the quantity and quality of information. I'm going to refer to that a couple different times because that is important, both in terms of how you get to the end result, but also in terms of what the value of your business is. And we'll talk about that in just a minute. But in an appraisal or a valuation engagement, we're going to get a lot of information, not just historical financial information, not just the numbers side of thing, which I call the quantitative aspects of valuation, but we want a lot of information about the qualitative aspects about your business. We want to understand your business, probably not as well as you do, but we're going to ask a lot of questions that help us assess certain elements of your business that allow us to select certain multiples or select certain discount rates. And we'll talk about valuation, how it's calculated in just a minute, or the methodologies that we apply. As opposed to a calculation engagement, might be much more numbers driven, maybe a little bit less qualitative. The reporting is very minimal, where we just got done doing appraisal reports 130 pages long, right, from start to finish, including the exhibits. Whereas a calculation engagement, the letter report's going to be maybe 5 pages with maybe 30 pages of Excel spreadsheets, which demonstrate what the analysis is. And so much less rigor, much more cost effective than the compliance driven document on the appraisal side. For M&A purposes, typically we do a calculation engagement almost exclusively, unless there's some buy-sell agreement, some legal document, or other compliance reason to do a more rigorous analysis. So generally we do a calculation of value. And so value in its essence, though, no matter what the scope is, is effectively a very simple formula. And there's two formulas depending on whether you're using a cap rate or using a market multiple. Value equals earnings divided by a cap rate, or value equals earnings multiplied by some multiple, okay? So the math is not very complex, it's very simple, but the inputs can be very complicated depending on the nature of your business. Earnings, for example, how you report your earnings can depend or be substantially different than what we would use for valuation purposes, because some of those maybe income items or cost items aren't really part of the normal operations of the business, or they might need to be adjusted for how we value the company. So let's take a company that owns real estate, for example, that has a couple of owners, and they pay themselves really high compensation to, as a C corporation, to keep their tax liability on a regular basis relatively low for tax purposes. Well, from our perspective, we value the business separate from the real estate. So the business hasn't been paying rent. So we're going to need to try to impute rent on that earning stream. And then we're going to need to normalize that compensation if it's excessively high in a C corp or excessively low in an S corp to get to what the true economic earnings of that business are. And there's other types of adjustments for non-operating, non-recurring type events that happen regularly within businesses. And we want to make sure that what we're trying to get to from an earnings perspective is, what would a hypothetical buyer, prospective buyer, expect to gain in terms of earnings from that business on a go-forward basis? Okay, so that's the earnings piece of it. The other piece of it is the discount rate, cap rate, or the market multiple. And that's driven as a function of some empirical data, whether it be actual transactions out in the marketplace or empirical data with regards to interest rates, equity risk premiums, industry risk adjustments from a beta perspective under a capital asset pricing model. Those are all what we call systematic adjustments. They're empirical. You really can't change them per se. They're either industry focused or market focused. And then there's the non-systematic component of it, and that's the individual risk associated with your company. And that's where the qualitative aspect tends to come into play, right? So do we have a lot of reliance on a key customer, for example? We had a client that we did some valuation work for estate planning purposes, gift and estate planning purposes, and they had a significant customer in Home Depot, and that represented over 40% of their business. That's a very substantial component of their business. Several years after we had done the valuation, they lost that customer to a Chinese competitor. It devastated the business, and it took them almost a decade to recover that lost revenue. Now, Home Depot as a customer, though, not only is it a significant risk from a customer perspective, Home Depot also pushes margins, right? They drove margins through the floor. So they were a difficult customer to work with, but they were a substantial customer. So when we think about value, you know, the two questions I usually get is, what's my business worth, and how do I increase the value of my business, right? Well, we're kind of walking through the what's my business worth. Well, as we do that, you can start to see some of the buttons, if you will, on how to increase the value of my business. If it's earnings times a multiple, if I increase my earnings or decrease my costs, which effectively increases my earnings, I'm going to have a more valuable business. For every dollar that I put to the bottom line on a 5x multiple, I'm getting 5 times that benefit or return, if you will, in value of my business. So if I can grow my revenues, right? If I can increase my prices or increase my volume, whether it be services or products, I'm theoretically going to increase my bottom line as long as I can keep my margins the same. If I can cut certain costs, right? Focus on profitable products and services, and maybe get rid of time-consuming products and services that don't generate a profit, or that just kind of fill time so that I can use that time, if I free it up, to find other products and services or customers that actually are more profitable. So increasing earnings, decreasing costs, automation, streamlining processes. I mean, there's a lot of different things that businesses can do to increase the value of their, or increase their earnings, which will increase the value of their business. On the risk side, value can be affected by market forces, right? Interest rates right now are at historical lows. In January, we were below 1% on the 10-year yield. And when you bring interest rates down, it allows for increased asset prices. You see it in the stock market every day. We're seeing it today, for example. The stock market's down. Why? Well, the 10-year yield's up. Well, what does that do? It changes discount rates, right? Which affect valuations. And so when discount rates go up, values go down. So we want higher earnings and lower discount rates, and higher earnings and higher multiples. And the market forces, availability of liquidity in the market, interest rates, all of those things are more or less out of a business's control, but they can affect timing, okay? But what you want to focus on are the things that you can control, and that is timing of when you sell your business, and you can plan for that in advance, how you grow your revenues. When we talk about risk, one of the issues that buyers like to see is a trend. So we'll look at history as a representation of the future. Maybe we have a forecast, maybe we don't. Buyers, at least buyers that I've seen, generally speaking, in most businesses, don't like to rely on forecasts. If you get into the forecast situation, if you really think your business is going to take off, a lot of times what will happen is the transaction structure will be bifurcated, and you'll get a certain amount up front, and Bob can probably speak to this more than I can, and then that expectation that the seller thinks might be structured in an earnout, for example. Okay? So that risk is what we're looking at. And so if you have a trajectory of revenues that are going up from left to right, from prior years to the current year, that's a good trend, right? If all of a sudden now with COVID, for example, some businesses took off and other businesses dropped off a cliff, right? And then if we can get that back up, maybe we can get buyers to say, well, we've got an explanation for that. We've got a reason for that change in trend. But it's always easier to tell the story when you've got a nice revenue trend, a nice margin trend, and a nice earnings trend. Because what that tells the buyer is there's maybe less risk in that. And those types of trends aren't just driven magically or automatically. The owners, you guys, the owners of the businesses, have a lot to say in how those trends get affected. And so if you can build structures within your firm that drive that in terms of measures like key performance indicators, that generally that which gets measured is that which gets outperformed for most people. People like to exceed whatever goals, as long as those goals are manageable. But it also gets to the risk side of things. So let's talk about risk. We talked about customer concentration, maybe supply chain management. A lot of companies are having huge supply chain management issues right now. Now, that's a temporary thing, hopefully, but you want to make sure you don't have too much dependency in a single supplier, for example, just like a single customer. So if you can minimize that, spread that around, that can help minimize that. And there may be logical reasons for not doing that, but again, it's what's that willing buyer, how is that willing buyer going to perceive that element of risk? Reliance on key people is another big issue that we see in valuations that we do, whether it be a key owner or maybe a key manager in the business. We just did a valuation, I would say early last year, might have been the year before, and the owner was up there in years. They were in their late 70s already. And this happened to be a shareholder dissenting case because one of the two owners passed away, but the same principles apply because we had to do the valuation to a sale context. So you had one remaining owner that is up there in age, and they had two other key people, okay? And all of their employee base had long-term employees, but they were all nearing retirement age. So we have this situation where, yeah, the business looks good, but you've got a lot of risk of you don't have any new key people that can come in and take over for the owner. You had one individual was in poor health. So you have all of these types of things that could have been avoided with advanced planning maybe 10 years ago. In this individual's case, had they structured that employee base differently, it might have been easier. Now, maybe there were specific reasons they didn't do that. I don't know. But from a risk perspective, again, from a buyer's perspective, they look at that and go, there's too much reliance on the key people. And so there's the risk that we can't continue to attain those future earnings. We did another deal. This was probably 3 or 4 years ago. It was a distribution company, nothing fancy. They distributed a very simple product nationwide, and they got an LOI from a private equity, a family office, private equity out of New York, that they wanted to do a synergistic transaction with their Houston-based company that did similar product. And this particular owner was the driving force in this business, okay? And there are ways to get around some of that risk. And again, Bob is probably going to talk to that to a certain extent with employment agreements, right? And so this particular owner, because they were so involved in this on the sales side of the business, he had a couple of key people that were younger that were qualified, but that transition hadn't really happened the way that it needed to happen. And so he was forced to take a long employment agreement, which, he may or may not have wanted to do. He wasn't very old, so it was probably fine for him. But that's something to keep in mind. Again, it's how do we mitigate that risk? And some ways you can do it by legal construction, structure of the agreement. Otherwise, it's advanced planning. Okay. The other issue that came up in this particular deal was market focus. So I've got a certain product or a service, and it's directed towards a particular market, right? And maybe I've got a whole bunch of other markets, but I've got this one area. And currently, this happened to be in the oil and gas industry. Oil prices had tanked. And so that portion of their business, the buyer was very skeptical of. They were a Houston-based business. They had a lot of reliance on the oil and gas industry already, and they didn't want another play that had a heavy reliance on the oil and gas industry. So when they put forth their LOI before they were able to do due diligence, they had a fairly low multiple, in our opinion, because of the concern of a couple of different risk factors: reliance on key people, a market focus, and there was a couple of other things that through the process of due diligence, we were able to, because we were part of the transaction, help them understand that those risks weren't as significant as they expected. I mean, this company was doing about $9 million in EBITDA, so it was a pretty substantial amount of EBITDA. And we were able to show them in the financial records that excluded everything to do with the oil and gas industry. We completely stripped it out and, discussed some of these other risk factors, were able to mitigate that and got the multiple from a 5X to a 7X on a company that really was not that sexy at all. It wasn't a unicorn from a technology perspective. It was just a simple distribution company. And we took that value from $42 million to $60 million in a matter of a few weeks by just mitigating, or not mitigating, but explaining that risk, right? Because buyers have perceptions that may or may not be true, and we want to help them understand whether or not that is legitimate or not. So when we go through a valuation process, we're trying to understand what keeps an owner up at night. What have they identified as the key risks in their business? Because that's going to help us understand what the buyer's perspective might be. And we want honest answers to those questions, especially if we're advising in an M&A context. I mean, obviously we want it in all contexts, but we want to know what those are so that we can provide the best answer. If we don't because we're not going to do the level of due diligence that a buyer is going to do, but we want answers to those questions that are honest, because you don't want skeletons in the closet. you don't want those to come out during a deal. It's much easier to deal with them on upfront basis as you're going through that initial process. Because, we've seen other deals that, the buyer will come in with a fairly high LOI, they get into due diligence and they find skeletons in the closet through that process because maybe there wasn't a quality of earnings report done on the front end, and they find this and they lower the value or they back out of the deal completely. So again, increased earnings, decreased risk is going to lead to a higher value. So that's kind of my overview. The methodologies that we apply are pretty straightforward: income approach, market approach, cost approach. Okay. Cost approach you see in heavy asset intensive firms. We see it actually a lot in like auto dealerships. We'll do that, but we'll do a blue sky calculation for the intangible piece of it. But most businesses that are operating profitably are going to be done under an income and a market-based approach. And that income approach, again, is just earnings divided by a cap rate, if we're going to do a simple cap of earnings method, or a discounted cash flow where we're going to look at future earnings, present value that back to today. And really, the cap rate and the discount rate have the same components. The only difference is in a cap rate, you deduct off long-term growth. So you assume a steady trajectory of growth in earnings. And that may or may not be the case depending on where you are in your business. That's where a discounted cash flow method, we can model what some of those, we're going to open up a new plant next year. And so we can model that in to help get to what the actual value will be after the fact, if you will. It's hard to do that on a cap of earnings basis. And then under the market approach, we always look at historical transactions in the company, for the company. The key there is quality and quantity of data again. It's just like your financial information. The better quality your financial information, less risk, right? The better quality of transactional data that we have, the better the answer that we're going to get. There are a lot of companies that are small companies that are niche, that are hard to value. But what we have found is if we expand our scope a little bit and get a lot of transactions, even though they're not maybe quality transactions, we do regression analysis around margins, and we pick selections around size and profitability so that we can narrow in on what investors are really seeking, even within a broader industry focus. And so we can get to a closer answer, even if we don't have 10 really good pure play comps, for example. The other methodology, depending on size, is a publicly traded guideline company method. And we do this a lot even for small companies, because if nothing else, it lets us know how is the market perceiving an industry right now, okay? Transactional data is historical. And some of that transactional data, like in 2009 and 2010, was gone. It didn't exist, right? Because there was no liquidity in the marketplace, for one, and nobody was doing anything in terms of a transaction. And we saw a lot of this at the beginning of COVID. That changed really quickly, but you started to see some of those same elements from a liquidity perspective, but it just didn't materialize. So, public company data can give us information about where we are in the markets today. The challenge with publicly traded guideline companies is they're very large. They tend to be very diversified. And so aligning that with a smaller, closely held company is more challenging. So for really small companies, you kind of start to shift, from kind of your middle market to Main Street, your mom and pop stuff. You really start to get out of the EBITDA multiple side of things. And when you've got a one owner type business, coffee shop, maybe a franchise, restaurant or something like that, machine shops, those types of things, you transition from EBITDA down to what we call seller's discretionary earnings, because the buyer is really just buying a job, right? And so what does the business earn before that owner's comp? Okay. And we see a lot of really good regression analysis around SDE for various businesses. And certain businesses like coffee shops, we can value those by state, by location, whereas most businesses, we have to look more nationally to get our data because there's just not enough transaction data in this local marketplace. It's not like your residence, right? Your personal residence where you can look at the transactions of sales right around your home and try to make adjustments for how much work remodeling you've done to your home versus your neighbor who sold. Business is the same way. We're trying to assess how valuable your company is by looking at the differences, mostly from a financial performance perspective, but also from a qualitative perspective, and in terms of measuring earnings and risk to get to value. So at that, I'll leave it at that and open it up to questions then.
So Lee, I've got a question for you. What is the what type of a time frame does it take from beginning to end? I'm sure there's some assumptions in there for completing, whether it's an appraisal or a calculation engagement.
Yeah, timelines really depend on quality of data, right? So if we've got really good, clean financial information, and it's as of year end, let's say, we can do a calculation of value in a week or two from the time which we receive the assigned engagement letter, the retainer, and the preliminary information that we request. So for a simple business, it only takes us a couple of weeks to turn that over. If we get financial information and we start seeing a lot of anomalies in that financial information, there's a lot of adjustments we have to make to that financial. Now we're almost acting like we're doing accounting work. And so that really slows the process way down. And so we've got to ask a lot of questions because we don't know the information behind that. And so we've got to ask a lot of questions. There's oftentimes a lot of back and forth. Sometimes we'll get information that answers the question. Sometimes we won't. So that can really slow the process down. So timing depends on flow of information, quality of information. That's really what it comes down to. And then our cost obviously is affected by how much time we have to spend. And so if we can do something really quickly, we can do it at a relatively reasonable cost. If it takes us a long time, we have a lot of adjustments, it takes more time and costs more. So appraisals on the other end, by its very nature, take more time. And so there you're really looking at 4 to 6 weeks worth of time because it's so much more in depth. Our information request list for a calculation initially is on less than a page. It's usually 10 items. For an appraisal, it's 3 or 4 pages long in terms of the request list that we have. And so there's so much more we need to know about the company in an appraisal because we don't just have to understand it from determining the numbers like we do in a calculation. We have to document it. And so the documentation takes a long time for us to put together. I mean, you think about a confidential information memorandum, right? You're trying to sell your business and you got to put together this big document. Well, that big document is basically what we put together on the front end of an appraisal. And then you have the valuation or the financial analysis section, and then you have the valuation analysis section. So it's a fairly lengthy report, it just takes more time. So I know that's a long-winded answer, I'm sorry.
Well, no, that's helpful. Just to put some brackets around it. Before I go back to Bob with a question that came up, I wanted to give a little blurb about myself. I serve. I'm the president of Pacific Northwest Advisory, and I serve as a fiduciary, working exclusively with business owners, providing, and this is important, providing independent, unbiased guidance. We have, over the past 25 years, created a private company sales process that incorporates valuation, tax planning, and the modeling of that transaction based on an objective view of the needs of the seller and understanding, to Lee's point, really deeply understanding what that business owner is wanting to accomplish, and then making certain through our financial analysis, can they get there in this business cycle? And that's something that Lee touched on briefly is, in each individual business, they have their own individual business cycle. And, in a perfect world, as you look ahead for when you're planning to begin to sell the business, you also want to look at your business cycle, because clearly you'd rather be on that upswing as you're looking for buyers rather than on the downswing. And you can't really control that business cycle, but you can control how you head into it for the specific goal of, striking a deal at a high watermark, or also recognizing that if I can't bring it together, if the right buyer doesn't appear, then I recognize that I'll go through that next trough and be prepared again at that next business cycle if I want that high valuation, assuming that there's no other issues. Prior to forming Pacific Northwest Advisory, I was an executive director at Morgan Stanley for 24 years. And I've been recognized as a top financial advisor by Financial Times, Barron's, Forbes, and have earned the Certified Investment Management Analyst designation. So my role is to shepherd that business owner through the process of selling their business, helping them fill in what I want to fill in the holes in their management team around a sale, finding experts like Lee and Bob to come in and to focus on their area of expertise to provide that value that we need for that. In Lee's case, understanding what the value is, so that then we now have a sense of, okay, if we were able to sell the company, what is the end result to the buyer, to the seller? What's the dollar amount at the end? And then we can go in and do all kinds of different charitable structures. We can do gifting to try to accomplish some of that buyer's goals, as well as improve the number at the very end. And once we've done that, we then have that ability to then march forward and become much more focused on a formal sale process. And whether that's someone from your industry, whether we need to find an investment banker, a mid-tier investment banker to run a search, really depends on the business cycle, the size of the company, and the goal of the current owners. And then once we pull that together, we've got that team together, then my role is oversight to make sure that the players are on task, that if they say they're going to get things done in 2 weeks, that they're done in 2 weeks, and to be there for when that business owner says, what do I do? Lee has a question, Bob has a question, it's A or B, what do you think we should do? And to be a sounding board, given the experience, to help them navigate through those questions, given their goals, their ultimate goals. And then once the transaction's complete, we build or prior to it being complete, we build an implementation plan, which allows us to, once the transaction's over and the wire from the transaction is in, we have an investment plan, we have an income plan, and essentially the buyer can then head off into the sunset with a monthly check every month, just like it was when they were working. So do you have a question, Dana?
I do have a question. This is great. Thank you, Doug, for what you were just saying. And it actually made me think of something for you, possibly Lee. Can you talk a little bit about, I guess, once a valuation strategy or methodology is decided on, and then you do this initial valuation, in terms of updating this valuation periodically over the years, how often do you see this methodology change or adapt? And then what does that do to that whole process? Does it start over? Does it, where you use more of this qualitative data, which is a new concept for me? I mean, that makes perfect sense, but that's not how I've been looking at it. I guess that can change quite a bit over time with some of the quality of the data just as the company is evolving. But I think you might get my drift here if you can kind of talk about that continuing valuation process.
Yeah, so the methodology is likely to be very similar unless something structurally has changed in the company, or something has changed in the fundamental data that we're relying on. But generally speaking, if you've got a mature business, for example, that's growing steadily, or it's maturing, and we can do a capitalization of earnings methodology, whether that be based on most recent earnings, or weighted average of the most recent couple of years, et cetera, or based on next year's budget, for example, we're probably going to apply that methodology unless something happens in the business that causes us to change. If we've got a business cycle, for example, construction industry, for example, construction industry cycles, relatively quickly in a 3 to 8 year span. And so we might have a longer year focus historically because construction companies have very little visibility, generally speaking, from a forecast perspective. So if their business cycle changes somehow, we might vary that up a little bit, but we're still going to apply an income approach using a cap of earnings methodology. We're still going to apply a market approach using market data. The inputs may change, right? Both from the market perspective and the qualitative risk information that we get back from the company may have changed, right? So those inputs are going to change, which will affect maybe what the baseline market multiple is, as well as how much risk up or down we're going to apply to that multiple. But by and large, the methodology might stay fairly similar. Sometimes in marginally profitable companies, we will shift to add a cost approach, right? Because now the floor of value becomes almost a liquidation price, right? It's almost better off dead than alive. If we've got let's say we've got a machine company, and they have a really bad year and their profitability drops, but their equipment is still worth what it's worth. The obsolescence there is maybe a little bit of economic obsolescence, but the functional and technological is still there. That value is going to have certain floors. So we might bring in a cost approach. But generally, by and large, that methodology should stay fairly consistent from year to year. But doing it from year to year, as a valuation person, I'm going to get better information on the qualitative side, right? Because the first year engagement, I can only get so much information. Then next year, I'm going to garner more information. If we do it 1 year, then we wait 5 years to do it again, I'm starting over, right? If we do it every other year, that's a fairly reasonable cycle. We're only adding 2 years of historical financials. I've got enough recollection about what happened 2 years ago that I feel fairly comfortable in asking additional questions so we can learn more. So it really just depends on the frequency of the trend of the update and what's going on in the business and what's going on in the markets. But generally, it's fairly similar.
Good. Any other questions at this time? So Bob, will you address will you address when and where we need valuations and maybe a distinction between the calculation and the appraisal, whether in the tax planning world, in the business transaction world, in the buy-sell world?
Sure. And let me do it in 2 parts, I think, to answer the question. Yeah, I think what would be really helpful is to answer that with common mistakes that people make, because we can learn from others' mistakes. And I've identified 6 mistakes in the valuation context that people make. One of which is, to directly answer your question, not planning at all or getting stalled during the planning process. And what I've learned over time is that the average business owner spends only about 4 hours on transition of their business and strategizing about transition of their business. That's less than the amount of television an average American watches on Saturday. So it's incredible to me. The fix for that is getting transition strategies in place. And those are the tools that we were talking about. Lee's package of putting the valuation gives us numbers that we can work with, but then we have to use tools like buy-sell agreements, trusts, family limited partnerships, transition agreements, sale agreements, those types of interactions. And it could be in the form of a gift, it could be in the form of a sale transaction, it could be a part sale, part gift, or it could occur at death or upon disability. So we look at life events, and hopefully through avoiding the first mistake, which is no planning at all, there is paperwork in place that governs what happens during those life events and price can be determined through appraisal, through valuation, or through agreement, or through whatever mechanism the company chooses. And then payment can be made. The second mistake that I find that people are doing is they're trying to do it themselves. And there's a sub mistake in there, and that is hiring the appraiser directly. A lot of people think that, maybe I don't need to hire the expert. I can just kind of, put my thumb in the air and determine what the value is because the multiples in my industry are this. That may or may not work for you, but hiring experts is really important because it will get you where you need to go with information you need to make good decisions. The sub trap that I want to bring out that's super important here is that if you engage the valuation expert yourself, all of that information, the drafting, the discussions, the expert, everything is obtainable through subpoena power, through depositions, and through discovery in litigation or audit if there's going to be a regulatory audit. When you hire an attorney that then engages the expert, all of that can be protected by the attorney-client privilege. So having that attorney-client shield when hiring experts is very important in terms of protecting the discussions, drafts, and dialogue to get to the ultimate number that is reported to the regulatory agency during the divorce proceeding or during the litigation or sale process. The next mistake that people make is trying to beat the service or thinking that the IRS is not going to know. There's 300 million, 400 million people. How are they going to know my business? If I'm close, isn't that good enough? And the IRS, that's like audit roulette. Do it right, sleep at night. That's what I say. And I think that having a valuation and getting reasonable reports and doing things correctly, it'll be a better result in the end, because you may beat the audit and nothing may happen. But on the other hand, if audit comes up and you don't have the valuations, that's a big problem. Along those lines, a next mistake is cutting corners, not spending the money to do it right. All the time I get people saying, well, look, can I just use the tax roll? Can I just use a market analysis? Do I really need an appraisal? Do I really need to hire a valuation expert? Can I just use the EBITDA multiples that are in my industry that I'm aware of through associations? Again, it's better to hire an expert in the field depending on what you're doing. If you're just curious, your EBITDA multiple may work just fine out of curiosity. On the other hand, if it's a death tax reporting event or a potential acquisition, I think having better data can produce a better result. Also, to one of Lee's points, another mistake, and this, Dana, goes directly to one of your questions: how often do you need the report? Really, if you do it year to year, that's great for tracking curiosity, all the reasons that Lee talked about. But if you have a life event, you really need to have the report done contemporaneously with that event, whether it's disability, divorce, buyout, sale, death, whatever has occurred. You got to have the report done contemporaneously. Report more than 6 months old is going to be considered stale and may not be and carry the weight that a current report would. I did have a real case where the auditor, a gift was made back in 1984. The auditor audited the case. We thought the statute of limitations had expired. It had not, because the client had not reported the gift, and therefore the statute of limitations did not apply. The first thing the auditor asked for was the valuation report, and the contemporaneous valuation report, not the one done today. And we pulled it out of the file, and the auditor was stunned and said, wow, 97% of the cases, there's no valuation report or no contemporaneous valuation report, and that ends the audit. We win. I guess we go to the next step, don't we? And I said, yes, sir. So doing it contemporaneously and having that report is good. The sixth mistake that people make in doing these valuations is it's great to know the data. it's great to have the legal documents in place, but sometimes people forget about the funding aspect, especially if we're transitioning a business. How do we set up the funding aspect of transitioning that business? So you have a great shareholder agreement, you have your valuation report, everything's in order, and it comes time for the employee or the family member to transition and purchase the business. Well, how are they going to do it? Because generally they're not wealthy. And so that's a challenge we have to do, is figure out, is it going to be a note where you become the bank? Is it going to be a finance transaction? Is there going to be life insurance involved or disability insurance? How do we fund the transaction? That's the back part of the equation whenever there's a transition strategy. I think getting things done is probably one of the most important things. I see we have about 2 minutes left. So Doug, I'm going to turn it back to you and the group to see if there's any questions.
Yeah, what I actually put this until 12:15 just in case we ran over, you know. So, but first I want to see if anybody has any questions, since you know we've been kind of talking and sharing a lot of information. Anybody have any questions at all? Okay.
Can I make another comment?
Yes, Lee. I'm going to ask you to
on the risk side of things for valuation, having agreements done is very important to a buyer when they do their legal due diligence. If you've got IP, if you've got trademarks, trade secrets, making sure all of that is protected. And then, you know, when you do internal transactions, buy-sell agreements, in shareholder agreements or buy-sell provisions need to be well thought through by an attorney that understands that, like Bob, because, you know, just in the last 18 months, we've been involved in 3 different disputes. One went to arbitration. I just got done testifying in. The other 2, one, we were one of the first appraisers, and the other one, we were the final appraiser, being the arbiter of what the value is. And so, you know, make sure you've got those agreements done, for one, so you don't have litigation, and make sure they're worded appropriately. Feel free to, you know, even if you have to pay a valuation guy an hour or 2 to let them look at the valuation provision, you know, what would their interpretation of this be? Because oftentimes, you know, oftentimes we document something in an agreement, and then, you know, we put it in a drawer until it needs to be utilized, and we pull it out 10 years later and we go, what did we really mean? And someone tries to interpret it. You know, I'm not an attorney. I look at a lot of agreements, but what's the legal interpretation of that? You know, just the definition of EBITDA, is that even a defined term? You know, so just make sure those agreements are up to speed, your leases, you know, all of those things. You want to make sure you've got those buttoned down. You know, we're not going to, from a calculation of value perspective, get too down in the weeds on those types of things. But they need to be there because they will affect how a buyer looks at that business from an M&A perspective. So,
hey, Doug, let me add to that a topic that we haven't brought up today that's an important topic, and that's the context of what the valuation is being done for. Right. And the reason is because in a valuation context, Lee talked a lot about, you know, making sure to maximize the value. Well, sometimes we're trying to minimize the value. Sure. For example, in a death context, we're trying to minimize the value of an entity for purposes of avoiding estate tax or gift tax consequences. And, you know, in that context, a lot of times, and Lee can talk to this probably better than I can, discounts are offered for valuation depending on what documents you have in place and how your company is structured. There may be minority discounts or lack of market discounts, and those can vary from anywhere from 5% to 45%, sometimes even a little bit higher, but do need to be justified. Judge Laro in our Ninth Circuit said, I will accept discount reports, but you must have a contemporaneous report from an expert justifying the discount. And if you do not have that, I will not give you the discount. But he also said, if you do get a discount, be prepared to live with it. So don't argue that the company value is going to be X for the sale to an employee, and then 3 days later argue it's X divided by 2 for a death tax return report. It's gonna, so we really have to be smart about when we're valuing things, how we're valuing things, and make sure that independent events occur between valuations at a high level and valuations at a low level if we're doing valuations for different methodologies. Because Lee will tell you, if you want a high value for something and you want a low value for something else, there better be intervening events, because the data is the data. Yeah. And I get people all the time asking me, do I want a high value or do I want a low value for this? And I usually tell them, we want an accurate value. The data is the data.
Correct. Yeah. And that's very true. And I was speaking in the context of an M&A where we're valuing the whole company. And obviously we want to, owners want to maximize that investment. So the ultimate goal is to try to maximize that value. Now, at the same time, on the tax side of things, we want to minimize the value for transfer tax purposes, right? And so let's stick with the value of the company and let that be what it is. But if you're doing minority transactions, they need to be done on a consistent basis. And we need to apply the consistent discounting process to that. If we're selling the whole company, that's a control market value. So that's a completely different context than valuing a 10% interest that father is gifting to the children, right? Where we can value the whole company, get to what that marketable, control marketable value is, and then let us use the data to determine what that minority interest discount is and discount for lack of marketability. And even further, if we've got planned, we've got non-voting shares so we can maintain control, still gift off a larger portion using non-voting minority interest, which get you an additional little kicker on the back. So, our methodology and the tax courts, have borne this out, that the old benchmarking that appraisers used to do, where you say, look, we've got restricted stock studies over here, we got pre-IPO studies over here, the average and median is 35%, we're going to do a 35% discount for lack of marketability. Those days are gone. You can't do that. You've either got to get down into that data and find current data on restricted transactions that are similar enough to apply, like in a publicly traded guideline company method, to your entity, or you've got to apply some other analysis. And we do a separate quant analysis using option pricing methodology that really gets to what's the fundamental concern with discount for lack of marketability. It's primarily holding period risk. Given the rights and duties and responsibilities of a minority interest holder, their risk is volatility over time, right? When's their payout? Well, they have no control over distributions. They have no control over when the company is sold. They have no control over that holding period, and it's going to be long. And the longer that history is, the longer our expectation can be, and that higher that discount could be. So, let us do that piece of it, operate your company and maximize it. And then on the discounting side, we can get that with the data. And it's not always 35% for DLOM. It's just not for discount for lack of marketability. I mean, we're doing some real estate holding entities. We were doing some in May, June, July of this past year, and our discounts were, on a combined basis, were over 60%. 60 to 68%. That's a very high discount for a transaction of minority interest because the data supported it. Okay, now it's come back a little bit, so it's not quite that high. We're back a little bit more normal, but our database information is now reflecting that, right? So we were looking at pre-COVID multiples, applying a REIT analysis on a post-COVID basis to get to that discount, and we think that's quantitatively supportable with our analysis. And now that actual data is starting to reflect that. We're seeing some of those low multiples. So let us do that analysis and support that in a full report for IRS compliance purposes. So yeah.
Bob, you have anything else to add?
No, I don't think so. I think the focus, actually, yes, I shouldn't say no and then talk. If I was going to say no, I would shut up. I think the focus from a business owner's perspective is understanding valuation is an important part of the process, but it is a process, and the process starts with the business owner and analyzing what is my exit, recognizing that at some point, whether they like it or not, there will be an exit. It may be a voluntary exit or it may be an involuntary exit, but there will be an exit. Step two, putting documents in place to cover what happens at the exit. Get a plan in place. Without those documents, the company gets liquidated or sold, or who knows what happens. Confusion abounds and lawyers have a heyday with that. Third thing, identify what is going to be needed for the valuation at what periods of time. What events are going to need evaluation, whether it be death, disability, bankruptcy, divorce, termination of employment, retirement, transition, sale, gift. There's all these different events that occur in order for evaluation to be necessary. And then third, don't forget about how do we fund the transition? Whether it's an internal organic funding mechanism, whether it's an external policy or sinking fund mechanism, or otherwise acting as your own bank in a redemption or a cross-purchase agreement, but funding that is very important. So the valuation is one important piece that fits in the bigger picture, which Doug is pretty good at seeing that big picture perspective. So with that, Doug, I'll turn it back to you. That was my no turned into a yes.
Well, thank you. Well, I think what I appreciate having these events with professionals like Bob and Lee. I took a full page of notes as well, and it boils down to process, and it's setting the course for the process. It's understanding there'll be zigs and zags along the way. But where we need those professionals, rather than us doing it ourselves, we reach out, we grab that professional, we get that information comes back into our input, and we're able to then use that on the go forward. It also allows us, and this is something I didn't point out, but it also allows us to, when we bring in a professional, a Bob or a Lee, for instance, we've all worked together on different cases. And so we have a camaraderie, we have a connectivity, we know how each other thinks. And so, 1 + 1 can certainly equal 3. And again, another reason to bring those professionals in at the right place, so that you get a quality of information and a quality of advice that you don't have to think about 3 or 4 steps ahead. And having to worry, well, was that done properly? Did I have the right professional? No, you get the right professional in the beginning, and that lays the groundwork for a positive outcome, which is, of course, a transaction or a gifting or some sort of a transition. If there, we are spot on time. So if there's no other questions, I'll wrap up unless Lee or Bob have any final parting comments. But other than that, I appreciate everybody's attendance, and we look to have another one of these in a couple of months. And if you have any recommendations as topics, by all means, send them our way, because we'd like to continue to provide valuable information that can begin that process of transition, or process of estate planning, or process of making certain that the house is in order, so that if there was some event that occurred that was unexpected, that it wouldn't be pell-mell, it'd be orderly and in control. And most importantly, the heirs of the owners will be taken care of the way the owners wanted them to be taken care of. And that's, I think, probably, the biggest point. So unless, Lee, you have anything else to say, or Bob, we can wrap this up, and I'll be in touch with everybody to get any comments from them on the event. But other than that, it's a wrap.
Thank you, Doug. Thank you,
Yeah,
Lee.
thanks a lot, Doug. The only thing that I would add is, if anybody has a question, feel free to, contact me directly or get a hold of Doug and he can get a hold of me. Send me an email, give me a phone call. I'm happy to answer. If you think of something after this, oh man, I didn't understand this, or he didn't address this, feel free to call me. I'm happy to help out anytime. I love talking to people, so it's great.
Yeah. And to that point, I'll send out contact information to all the attendees.
Great, thank you.
Thank you to all the
Thank you.
attendees too. I
Yes,
appreciate
thank you
your
very
time.
much.
All right, talk to you all
Thanks,
soon.
guys.
Thank you.
Appreciate your help.
Thanks for hosting it, Doug.
You're welcome.
Yep. Bye-bye.
Thank you.